This is Scott Becker with the Becker Private Equity Podcast. Today's discussion is 10 key rules on investing, and we hope you enjoy this. We think about this a lot. We hope somebody finds it helpful. If you have any comments, feel free, of course, as always, to text Scott Becker at 773-766-5322. So the first of the 10 rules is that allocation of your assets is everything, at least in terms of financial sanity. And what we mean here is, what is your allocation of equities to bonds to cash? And that will dictate a lot of your long-term percentage on investing and what your returns are, but also how well you can manage your temperament in terms of your investing. And we talk about this a lot, and we'll talk about it more in this list of rules on investing. We happen to love the Vanguard tools for understanding allocations. They're online. They're not a sponsor. I just happen to love their tools. Second, you must understand what you're investing in. And what this means is if you're investing in equities or investing in an index fund that you kind of understand, or investing in stocks that you understand, you have real convictions around them, or you're just taking gambles without really any thoughts or understanding what you're investing in. If you're investing in bonds, bond funds, investing in U.S. Treasuries or more risky bonds, do you understand duration? Do you understand credit risk? Do you really understand what you're investing in? Obviously, sometimes I'm guilty of not really understanding what I'm investing in. I've invested periodically in things that were just a whim, Bitcoin ETF, cannabis ETF, whatever it might be, without a real understanding of what I'm investing in. It happens sometimes when I'm invested with private equity and venture capital investors too. I'm just sort of taking a gamble. But at least I can understand that I'm taking a gamble and don't really know it. But my core investments, I better understand what they are. Third is develop a core investment plan and define your core investments. For myself, those are S&P index funds and U.S. Treasuries. But whatever you're doing, you should understand this is my core investments. These are my core plan and my core investments. I think it's very, very important. Assess whether to use an outside professional advisor. For many of us, this is a good idea. For others, it's not. But either way, you need to decide whether you're doing that or not. Fifth, and I think this is very important, is understand your own investment temperament and your own risk profile. And this may be different than what your financial advisor wants it to be. Your financial advisor might tell you you're far better off with more equities than bonds, more equities than cash, and so forth. But you have to be your own sort of gauge of what you could deal with. And there's a huge difference between what we call behavioral finance, what you could live with through market ups and downs, versus financial optimization, which is a different thing. Sixth, you want to develop clarity about your investment goals. Are your goals to get the highest return possible, or that you get a mid-level return with less risk? Whatever your goals are, you need to understand them. It doesn't mean the highest risk possible, but if you're looking for a 10% annual return, well, you better be all in equities, but you better be willing to live with the risk that that's not going to be consistent. That's going to be up or down over time. You sort of have to understand your own sort of investment goals to decide how your allocation is going to work. And this goes hand in hand with the first point, that allocation of your assets is everything. Seventh, I tend to bias towards index funds over individual stocks, but then in terms of the bond area, biasing towards individual bonds over bond funds. There's a much deeper explanation to this, but on the stock side, I think it's very hard to pick individual stocks, very much a lottery. So unless you're going to own a ton of stocks, you're far better off in what I think of as an S&P index fund, low expense one, versus trying to dabble and guess on stocks, which it's such a loss of information compared to professional investors, and even they're not so good at it. Eighth, never borrow to invest in stocks. And I think this is one of the most important things, no matter how much financial engineering somebody talks to you about. We believe that you should never borrow to invest in stocks. Ninth, you want to understand all your assets in your portfolio. If you separately own private real estate or private equity investments or a private business, this all counts as part of your higher risk equity side of your portfolio versus your cash and bond side of your portfolio. So when you talk to your financial advisor, you sort of got to understand what your real equity to debt mix is. Finally, 10th, I tend to bias towards safety over absolute return, but this is going to differ investor basis versus investor, and partly it's important to know what your own biases are and what you sort of need to live with. The last thing I'll say, which is a PS to all this, is no matter what you do have to keep some serious emergency fund in cash for a whole bunch of reasons. In any event, thank you for listening to the Becker Private Equity Podcast. Always feel free to text Scott Becker at 773-766-5322. Thank you very much.